We're now moving on to the discussion of the United States housing finance systems, which are all the arrangements and institutions that are supposed to facilitate home purchases with the help of mortgages. You may have noticed that the U.S. government encourages individual home ownership. The reason for that is simple. It is in the best interest of the U.S. government that individuals own their own home as opposed to rent, because home ownership creates stability in a country. People who own homes have something to lose. Therefore, they are less likely to demonstrate or start a revolution. In fact, home ownership is oftentimes cited as being part of the American dream. Since the 1950s, the U.S. home ownership has been somewhere between 60 and 70%. That is fairly high, but not as high as in some countries, such as many Eastern European countries. You remember from the introductory chapter lecture that in Germany, for example, historically, only about 52% of people own their homes. The reasons for the low home ownership rate in Germany are that homes are more expensive, that the government does not give as many incentives to homeowners, laws generally favor tenants rather than landlords, there are firm limits on rent increases, which benefits tenants, and loan requirements such as down payments are also stricter in Germany. When a loan is generated between a borrower and a lender, this process is called loan origination. When the loan is first originated, the originating lender owns the loan. However, oftentimes the loan is sold in the mortgage markets by the lender so that the lender can originate more loans. Therefore, mortgage markets are very important for the housing finance system and for borrowers' access to financing. Mortgage markets can be divided into primary and secondary mortgage markets. In the primary mortgage markets, loans are originated and created for the first time. In the secondary mortgage markets, existing loans are sold. Secondary mortgage markets therefore consist of transactions involving existing loans that are sold by the organizations that originate loans, called the loan originators, to investors or by one investor to another. In order to promote home ownership, the U.S. government has set up a number of institutions over time. Let's go back in history and review these institutions. Prior to and during the Great Depression of the 1920s, mortgages, the way they are structured today, did not exist. Instead, mortgages were short-term interest-only loans. That meant that large balloon payments of the principal had to be made at time of maturity. When the Depression hit, many people could not repay their home loans. Also, no one could afford a new loan. Therefore, banks could not originate any more loans. The existing loans were mostly delinquent, and consequently, many banks failed. No one could afford to buy a house. Therefore, construction of houses halted. In short, the housing market was in a chaotic state. So in 1934, the government decided to intervene by creating the Federal Housing Administration, the FHA. The overall purpose of the FHA was to help restore confidence in the nation's housing finance system. This government agency established three things. First, it developed lending standards which reduced lenders' risk exposure. Second, it promoted the use of long-term, fully amortizing mortgages. In a fully amortized loan, part of the principal is paid with each payment, so that the principal is paid back completely over the life of the loan. It is easier for borrowers to repay debt with gradual payments as opposed to one large balloon payment at the end. And third, the FHA established a mortgage insurance program that covers losses to lenders. The FHA therefore does not lend money. It also does not originate any loans. It only provides mortgage insurance. Why is this FHA insurance program needed? As a rule of thumb, Borrowers who put down less than 20% of their purchase price need to purchase some type of mortgage insurance, either through the government or through private insurance companies. They need to pay for mortgage insurance in order for a lender to agree to make a loan with a relatively low interest rate that is safe enough to be sold in the secondary mortgage market. With mortgage insurance, borrowers pay upfront and annual premiums to purchase the insurance that protects the lender from the risk of loss due to default by the borrower. In return, lenders are more willing to lend money at favorable rates with relatively small down payment requirements. For FHA-insured loans, the minimum down payment is typically 3.5% for a good credit score. When a borrower gets an FHA-insured loan, the minimum required credit score, which indicates borrowing risk, also tends to be lower. The types of loans are popular with first-time home buyers. FHA-insured loans have a maximum loan amount depending on the geographic area the house is located in and the local average home values. For example, the maximum loan amount in 2019 for an FHA loan for a single-family home located in St. Petersburg, Florida, was $314,827, but it was much higher in the more expensive Key West area, where the limit was $529,000. The limit can be even higher than that in some parts of the country. For example, the FHA loan limit was $726,525 in San Francisco, California. As you can see in this chart, during the real estate boom between 2003 and 2006, FHA loans had pretty much fallen out of favor. In 2006, only about 2% of all loans were FHA-insured loans. At the time, banks had a very lax lending standards and would give a mortgage to pretty much anyone. Banks didn't care very much about what people's credit scores were and how much of a down payment they made. They oftentimes did not even care how much the borrower's income was. As long as real estate values were increasing, any loan was a safe loan. At the time, banks wanted to make as many loans as possible because the more loans they made, the more money they made in fees and interest. However, after the mortgage crisis set in, banks became much more careful and had much stricter lending standards to work with. The only way banks now made loans to people that either make low down payments and or have high credit risk and low incomes is if they are insured. Therefore, the FHA loans became more popular again after the mortgage crisis. In 2009, nearly 18% of all loans made were FHA loans. This number has decreased since, but FHA loans are still quite popular. In late 2018, about 12% of all loans were FHA insured. Over time, the FHA program has been self-funded. It takes in money in the form of borrower premiums. And when a borrower goes into default, the FHA has to pay a claim to the lender from those funds. In the years after the mortgage crisis started, the FHA was in the news many times because its payouts were greater than its cash inflows. This raised concerns that the FHA may need to get taxpayer bailout money because its reserves could eventually fall under the minimum required 2% of the total insured loan amounts. In fact, the FHA had to increase its insurance premiums 5 times between 2009 and 2015 in order to replenish its insurance fund. As of 2016, the insurance fund was solvent again. What happens if a borrower cannot afford to put 20% of the purchase price down, but the loan amount is above the FHA lending limit? Can that borrower still get mortgage insurance? And the answer is yes, through a private company. An insurance program that is offered by a private insurance company is called Private Mortgage Insurance, or PMI. These programs compete with government loan insurance and guarantee programs. Again, just as for an FHA-insured program, borrowers pay a fee and/or a premium to purchase a mortgage insurance policy. However, with PMI, the policy is provided by a private company. Again, the insurance limits the risk of loss faced by lenders in the event of default by the borrower. In return, lenders are willing to lend money at more favorable rates with relatively small down payment requirements. PMI insurance is typically necessary when the down payment is less than 20%. While the down payment requirements for PMI mortgages are larger than the down payment requirements for FHA-insured loans, PMI loans are available for larger loan amounts than FHA loans.